probably the number one reason people overpay in taxes is not understanding that there's a huge difference between tax return filing and tax planning. Because where your numbers fall on December 31st, for the most part, will determine how much or how little taxes you pay.
Welcome to Real Estate Syndicator Live. I am your host, Mauricio Rauld. On this episode, I interview my good friend, Amanda Hahn, a CPA with Keystone CPA who specializes in helping real estate investors. We talk about the importance of year-end planning, how to pay your kids in order to avoid paying taxes on that money. We talk about how to write off the entire value of your vehicle, even if you put no money down. We talk about short-term rental loopholes and my personal favorite, how to deduct your home office. This week on Real Estate Syndicator Live, I got my good friend Amanda Hahn in the house, who I've known for, I've lost track, how before I had kids, so I know that. So it's probably been 10, 15 years since you and I have known each other. I am going to start calling you the CPA to the stars, to the celebrities. I think you have more celebrity clients than I do. I'm sure you're under NDA. I'm not sure you could disclose who your celebrity clients are. But Amanda, why don't you tell the community a little bit about yourself? Obviously, you're a CPA, but you're much more than that. So why don't you tell the community, say hello.
Yeah, I'm so excited to be here, Mauricio. I didn't realize that we knew each other before we had kids. And this is my first time on your podcast.
Yeah,
So
I'm pretty stoked about it. We
yeah.
do we have a lot of mutual clients, so we're always connecting and we're always hanging out at some of the same conferences. And I missed Bigger Pockets this year, though. I knew you were speaking at that. But anyway, tell them a little bit. You and your, most people don't know, you and your husband have a CPA firm, and what do you guys do?
Yeah. So our firm is called Keystone CPA. We are located in Southern California, but we have clients all over the US. And our specialty is in working with real estate investors. So our clients range anywhere from new investors looking to get started. So we have people who are physicians, attorneys, other CPAs who are our clients, where they might have a business or they have high income, but they're looking to build wealth in real estate. All the way up to clients who are some of the thought leaders in real estate and doing very large deals, large syndication. So kind of the whole realm of real estate. So most people come to us because of their need to have some tax planning or tax strategies in place for real estate. And outside of Keystone CPA, my husband Matt and I are also real estate investors ourselves. So, the side added benefit of us going to a lot of these conferences is not only do we get to educate, but we also get to learn kind of the latest and greatest from an investing perspective too. So it's really a win-win for us.
And that's such a huge thing, by the way, having your CPA be a real estate investor, because you would just assume, I used to assume that all tax professional CPAs, they just knew about the real estate piece, in the tax code. And that's not necessarily true. A lot of CPAs I know have to go look it up, or they've never heard of this, or what is this bonus depreciation? I'm like, literally everybody specializes in their own little niche. So being a real estate investor and just knowing the stuff back to front, I think, is huge. Guys, I've got a couple questions that Amanda and I could probably talk for 6 hours together, but I obviously want you guys to put your questions in there so we can answer your specific needs. I've got a fun game that I want to play that I thought of this morning to kind of get some tax things across. But before that, I do want you to talk about, we plan this thing as kind of our year-end planning episode, and I want you to start, this is super important to me, so I want you to start by talking a little bit about the difference, or why somebody should be really thinking about their tax for next year now, in November or maybe even earlier in the year, as opposed to showing up to your CPA's office on April 1st and dumping a shoebox full of receipts and be like, save me money on taxes. Because I think a lot of people, I always assume people understand the difference between the rear view mirror and looking forward. But why don't you talk a little bit about that and the importance of tax planning?
Yeah, I think the probably the number one reason people overpay in taxes is not understanding that there's a huge difference between tax return filing and tax planning. Tax return filing is something that we all do, right? Which is, we gather up all of our paperwork, look at our numbers, and we're really reporting on the right tax forms, what did or didn't happen last year. I did buy properties. I, didn't have an entity, right? We're just reporting the facts of what actually occurred. versus tax planning is something that you do throughout the year with your advisor, and you're looking ahead and saying, hey, what are some of the things that I am going to be doing in real estate? Am I going to be buying properties? Am I going to be partnering with other people? Am I selling some of my portfolio? And when you look ahead at planning, there are so many different ways you can structure a transaction to really maximize your tax savings. You know, a lot of times investors will come to me and say, hey, are you aggressive as a CPA or are you conservative? And what I tell people is, I'm neither. I'm proactive. And what that means is when you're proactive, you don't have to be aggressive, because being proactive means that you're doing the right things during the year to legitimately take those tax deductions. Aggressive, typically you're thinking of like, maybe I'm walking along the, kind of the gray line, or maybe something I shouldn't be doing, but I'm going to do it because I'm going to be aggressive, right? So especially now with, you hear about all the talks of the IRS having increased funding for audits. I think it's more important than ever to make sure that you are being proactive and doing the right things during the year, so that by next April, you're legitimately saving on taxes.
Yeah, because I mean, I want to get to these sort of end of year tax strategies for, for real estate investors, but obviously applies to syndicators as well. And so obviously syndicators, yep, real estate syndicators. But I mean, if you're going to do that kind of tax planning, you've got to do it in the current year. You can't wait until, there's a couple things I know you can do after the fact. I think you can do like 401k contributions or something after next year. But a lot of these great tax benefits that we get, we've got to do before the end of the year, right?
Yeah. And year-end planning is so important because it's the best time of the year where, for most investors and syndicators, right? By now, we have a pretty good idea what 2023 is going to look like in terms of profit and losses. And so in the next 30 to 60 days is a great time to meet with your advisor and say, okay, here's where I am. What am I expected to pay in taxes or not pay? And if I'm expected to owe in taxes, what are some of the things that I can do to reduce my taxes? Because where your numbers fall on December 31st, for the most part, will determine how much or how little taxes you pay. So we have people who say, hey, I heard you talking about paying your kids and taking a write-off, and that's awesome. And I want to do that for last year. And so I tell people, well, you can't do that for last year. Last year is already over. But certainly right now, before the end of the year, if you did hire your kids, or if you want to still hire your kids, you can still do that. We still have, almost 60 days where you can put those things into place. And so that's how, why we say year planning is probably one of the most impactful times to do planning. Because there are still a lot of moves that we can make. And especially for, sponsors or syndicators too, year-end planning is a really great time for money raising, right? Because we have, our investors who maybe have some large gains or large income that they're trying to offset. And so it's also a great kind of a marketing opportunity too, as part of year-end planning to raise money.
Yeah, we always see an increase in activity in December because everybody's trying to get that last minute close to get investors in. And they've got, I got another 50 grand or another 100 grand. Well, look, that was one of my favorite. I was going to go through a couple of my favorite tax strategies or year-end tax strategies, and you hit on one, so might as well go with it. Paying your kids, right? You can pay your kids. I love this one. And I'll tell you the way I know it, and I know it's so super nuanced because it's not as easy as just doing what I'm about to say, but you can pay your kids. I forget what's the minimum now though. Is it 13 grand for the standard deduction? What is the number?
Yeah, over 13,000 per person is what
I can hire my kids, right? I got 2 kids. I can hire my kids, pay them $13,000 to do work, and that will be a deduction for me and my business. And because it falls within that range, my kids won't pay taxes on it. So it's basically $13K of tax-free money that I'm passing along to my kids. Now I know there's issues, so I want you to kind of talk about a little bit more of the details, like documentation, and they've got to do real work and all that stuff. It's not just me writing them a check, right?
Yeah, I love how your eyeballs got bigger when you say that, because that's often the response I hear from people. So yes, it is. Paying your kids, people always asking me like, what do I need to do? What kind of documentation? And I tell people the easiest way to think about it is paying your kids is the same as paying anybody else. So for example, if you hired my kids to do what the tasks are, what are the things that you'd have in place, right? You'd have a job description. You would tell me how much you're going to pay me. There's going to be a way that I demonstrate or show the work that's being done. So you treat paying your kids the same as anybody else. And one of the key things the IRS looks for is reasonableness. So reasonableness in two ways. One is reasonable, their age and the task have to be reasonable relative to each other. So like your 13-year-old, maybe we'll do some computer stuff. Your 2-year-old, probably not going to pay them for any computer related things. And the second thing is reasonableness and compensation, right? So again, if Mauricio was paying my kids to do those same things, what's a reasonable amount that he would pay them? And that's how much you determine. So although, we typically say, hey, up to 13,000 is the amount of money that's free from income taxes, that doesn't mean everybody will get to that amount. If your kids are much younger, maybe the compensation is less. If your kids are older, we have people who pay their kids over $20,000 a year, especially for kids who are older, who are more capable of doing things. It still could make sense. Even, let's say your kid did have to pay taxes at 10%, but if you're saving taxes at 37%, then it still makes sense overall from a family perspective.
Yeah, that's key. I was about to say that because I know a lot of people, and I've thought about doing that one. I haven't done it yet, but you're paying zero taxes up to whatever that number is, 13 grand or whatever. And then anything above that, it's only 10%. So, and that's 10% of the margin, right? So it's 10% of that additional money on top. So it's not even 10% of the entire amount. So you could pay your kid over $20,000. Amon had a question, which I've got my favorite answer to, and it's probably wrong, but is there a minimum age requirement for your kids to work? Can I pay my 6-month-old for something?
Yeah, I mean, there's not an age requirement, like in terms of minimum or maximum. So yeah, it could be babies, it could be, a 40-year-old child, right? Your adult child who's moved back home. So there's no age requirements from an income tax or income shifting perspective. However, and that's I'm glad, Mauricio, you're here, there are always legal considerations like labor law, right? We can't pay our 8-year-old to be working 40 hours a week because that's just not legal to do. So those are always things we have to take into consideration when we talk about income shifting too. I mentioned the 40-year-old kid, right? But we do have a lot of people who are like the sandwich generation, where they have kids who are, semi-grown up, like young adults, and then they also have parents, like aging parents who are now retired or semi-retired, that they're helping out financially. So when you look at income shifting for year end, it's really anybody else that you are helping out with financially that maybe right now is you're just giving them money. But if you can have them help out in your real estate business, now we turn that into a deduction rather than just personal gift that you're giving to somebody else.
Yeah. In fact, I use just on my own. I use my father-in-law. Actually, he's retired. He's like twiddling his thumbs. And so he's kind of my personal runner. I need him to go run an errand, or I need to go build, I've got him working on what are these things called? The names came anyway. He's just building stuff for me. Like anytime I get something that needs a desk or something that needs to get teleprompter, that's what I got him doing. I got him doing a teleprompter. But the kids for me was also, first of all, it's not a lot. When you think about $13,000, it's like $1,000 a month. So it's not like it's $50 an hour. But modeling for me was always, I never ended up doing it with my kids, but you could pay your 6-month-old or 1-month-old to model if you've got them on your website, or you're using it for promotional materials if obviously it makes sense. But so you in theory could pay any age child to if they're doing something. And of course you got to figure out what's the going rate for a modeling contract. How much would a kid, if you went to hire a kid, always document everything. But it's not that hard to find out how much it would cost for me to go hire a 6-month-old to be on a campaign that I have that makes sense on my website, right?
Yeah, and it really differs from person to person too. For real estate investors, yeah, for younger kids, modeling, advertising, we see that a lot because it's common, right? That you're using that, or even some of our clients who are more into social media now, we see that. But we actually have a family friend whose son is an actual model. He just turned 18, but he models for like Abercrombie, and he gets paid a lot of money. And so to the extent, if that happened to be your child, you can imagine like that's a very significant amount of income shifting, even if it's for like modeling type stuff.
Yeah.
So yeah, it's going to differ depending on, the kid and their abilities and kind of what their experiences are as well.
Yeah. And Charles, thanks Charles for the comments. And my kids are in college and they do social media work for my business, and they get paid $1,000 a month. So as long as that's totally works, right?
I pay more than that to my social media people. So
that seems reasonable. Man, we got a lot of now, like really got people going with the kids. A lot of people don't know about this. I was a good friend of mine. I brought it up in one of his masterminds, and he's like, I had no clue. And he was just now from that point on was using this strategy. Now, Paul asked, can we hire a neighbor's minor kid to do office work such as data entry? And I mean, I assume the answer is yes, as long as you're complying with labor laws. I don't know how that helps you on the tax side because it's a deduction to you, but it's not your kids.
Yeah. You can you can hire me to work on the flower beds.
Right. And you can use that for anything, right? That money that you're paying your kids, I mean, you can use it to go buy, you know, Christmas gifts, and like it's just as long as you're used well, as long as, I mean, I guess you're paying them into their, do you pay them into a trust account for their, how do you set up an account if they're minors? Get into the weeds.
Yeah,
here.
I mean, typically it's just a custodial. Yeah, it's just a custodial account. So I mean, if they're young, right? If they're older, they can have their own account, of course.
Yeah.
But for the younger kids, yeah, typically it's a custodial account. So it's their account, but you know, you're kind of the signer on it. Fairly easy to do in terms of from a banking perspective. And you know, for younger kids, especially if it's for recurring work, like I don't know, social media, right? It's every week, every month they're doing the same thing. Usually those are more mimic like W-2s. And a lot of times people are kind of afraid of payroll. They feel like it's like this big thing where like they have to hire ADP or Paychecks where the large companies do. And some of our clients do have that, but a lot of like banks will also offer payroll. So that's why I would tell people to start like, hey, my rental real estate is an LLC and it banks at Bank of America. Just start there, you know, ask them about their payroll services. And a lot of times a payroll service is very affordable or sometimes even free if you do direct deposit. So it's typically not as complicated as I think people make it out to be.
Yeah, Gustav, I'll go one more. I don't want to spend the whole hour on how to pay your kids, but Paula was asking that, you know, this is a good one because it has to do with documentation. Paula said, last year I hired my 11-year-old to redo a flower bed at a property and to sell some appliances on Craigslist. She earned her keep. She signed no contract, but I hired her mom's permission. I paid her in ice cream, etc. Was I supposed to do more documentation? I guess that's not your own kid. That's somebody else's kid, but do you, I mean, for documentation purposes to the IRS, I mean, do I need to see an independent contractor agreement, employment agreement? What kind of documentation are we looking at?
I don't know that I would, you know, if someone just kind of working in the yard and things like that, I don't know that I would have a contractor's agreement. Probably, I don't know, emails, you know, correspondences like that would be sufficient. I think you were saying that Paula said it was payment in ice cream. So I imagine we're not talking about a lot of money, right? I mean, in the truest sense, the income shifting strategies, we're trying to establish you know, a kind of a decent amount of work, right? That's a, you know, somewhat significant dollar amount, right? So $1,000, $2,000 or more. And we want to have documentation of the transfer of money. So it's going to be a check. It's going to be a transfer from your bank account to their bank account. Those are the things that you want to do in terms of documentation. I think, you know, I don't know, ice cream, you know, I don't know, $10, $20. If you want to write it off, you know, I don't think it's a big deal. I don't think IRS will lose too much sleep over something like that.
Right. 100%. All right, let's go to my next favorite end of year, or not even end of year, just tax strategy in general. So tell me how wacky this is. So this is the game I wanted to play. I was going to tell you my outcome. I was then going to tell you the strategy, and then you can tell me how wrong I am or right I am. So I'm going to put in $10,000. I'm going to put $10,000. I'm going to pay $10,000. I'm going to write a check for $10,000, and then I'm going to get a $50,000 write-off, or deduction, I should say, not a write. I guess deduction, write-off, same thing. I'm going to do that by buying a business vehicle. I'm going to buy my car, an SUV, something that's qualified, which I think is 6,000 pounds. I'm going to finance it. So it costs 50 grand, but I only put 10 grand as my down payment. And I'm going to write off the entire 50 grand, even though I only paid 10 grand or 5 grand or whatever down payment I had to do. Is that cool? Is that kosher?
Yeah, legitimate strategy. And that works in almost everything in the tax world. You know, the tax code really favors debt. And we see that in the real estate sense too, right? You buy a rental property. I mean, whether you put 100% down payment, 20% down payment, or no money down real estate, the depreciation is exactly the same because it's based on the purchase price. And so that same theory carries through to vehicles that you're talking about. So let's say I'm buying a truck or SUV over 6,000 pounds. In our example, let's assume we're using it 100% for our business this year. Then yeah, your write-off could be up to 80% or even 100% of that purchase price, regardless of whether you put that $10,000 down or not. So yeah, you could put no money down if you wanted to.
That's right. That's why I just felt like, especially for a business, like you could literally go buy yourself a 6-figure vehicle, put down $10,000, and you've just written off 100 grand, which has always been an interesting concept for me. Before I get to my other one,
I think.
Yeah, go ahead.
Go ahead.
No,
I
go
was
ahead.
going to say, nowadays we have, with the fluctuation in interest rates, right? A lot of investors are looking more into creative financing. And we're seeing that even on the syndication side too. I think a lot of people think like, oh, I'm going to buy property subject to or seller carry. Those are just small single families. But I'm sure you've probably seen it too, Maurice. So like even on the syndication side, we see seller financing, seller, subject to type of deals, even at a larger scale. And so when we talk about depreciation and those types of write-offs, it's really important to understand, if I bought a smaller or mid-sized multifamily, and even if the seller carries some of the note, it makes no difference to me in terms of what my deduction is, right? My depreciation is still going to be the same purchase price that I bought the property for. And that's really important as we head into year end as well. People are like, I don't have money for real estate. Well, you don't have cash for real estate, but there's plenty of other ways to get real estate.
Yeah, especially in the mobile. I mean, we have a lot of mutual clients that invest heavily in mobile home parks, and that's a really one asset class where seller financing is really prevalent. A lot of legacy owners, a lot of people that just inherited that park from their parents or grandparents, and they don't want it, and they're like, hey, it's tough to get financing on a lot of those if they're dilapidated and 50% occupied. So cool. Before I go to my third one, because I want to obviously, I've got all my questions, but I always like the community to jive in. So I appreciate Vessi for asking the question, but this is probably more relevant to a lot of the real estate investors. So for real estate professional, the REPS status, how do you define material participation? It seems that only self-management qualifies, and education/admin/marketing do not, even though one could argue these two are necessary and ordinary activities. So can you count all the seminars I go to, the cruise ships that I spent a week on learning about real estate? Like what is material participation?
That's a great question. So, and this is, I think, often an area of confusion when it comes to taxes. So there's two different definitions. There's the definition of real estate professional status, and then within that, there's the qualification for material participation. So I always look at it as like big circle and little circle, the little circle within the big. So within the big circle, it's basically all types of real estate hours. So that's, you as a syndicator, you flipping homes, you being a realtor, right? You being a landlord. All those are real estate professional hours. So for us, at least with our clients, our argument would be, yes, it does include like marketing, learning about real estate. It's all real estate related. So they're all part of real estate professional. However, that smaller circle of material participation, that is a more stringent set of rules. And so those are typically going to be hours that you're spending on the rental properties themselves. I think that's where you hear like, oh, it's mostly related to property management kind of stuff. It doesn't mean that if you have a property manager that you are not having material participation hours, but it typically means it's harder for you because, the reason we have property management is that they're doing all the day-to-day stuff for the rental properties. And so when it comes to material participation, it typically does not include like learning about real estate, going to the cruise and things like that. Basically, the way I look at it is material participation hours are hours that you can specifically connect to a rental property that you own. So, if I'm dealing with tenant issues, I know which property, right? Main Street, Fremont Street. If I'm learning about real estate, it's not really connected to a specific rental property. So those are generally not material participation.
So we probably should have started with it, so just in case I don't leave anybody behind. So high level, in order to become a have real estate professional status, I know there's two requirements there. What are those two requirements, just in case somebody doesn't know?
Yeah, so there's actually three requirements. The first one is that you have at least 750 hours in real estate activities. That's what we were saying, real estate professional, right? It's all types of real estate stuff you can count. The second rule is you have to have more time in real estate than your job or your other income activities. And this is the one I think is harder for most people to meet who have a W-2 job. So if you're full-time as a physician, odds are you're not going to have more than 2,000 hours in your real estate. And so that's where kind of the real estate professional strategy works well for people who are married and they have a spouse who is not working full-time. And then the third requirement is that material participation that we were talking about, right? Materially participate in your rental real estate. And I think for those of the investors with us today, it's like, why do I care? Why does any of this matter? Well, if you are of high income, and this is defined as people making over $150,000, your rental losses are limited, meaning we can only offset other passive income. If you want to have your rental losses offset your W-2 income or your income from your other businesses, you or your spouse needs to be a real estate professional. So if you're a real estate professional, then rental losses offset all types of income.
Good stuff. Good stuff. All right, my last. Actually, no. Before I go to my last, because it's not quite related, but there's been a lot of talk. I think people are just trying to figure out how to get any time a tax write-off they can. But there's this thing going around that I've just seen a pickup lately of this sort of short-term rentals, right? How do I use short-term rentals to maximize my tax benefits? And I think it has to do with getting a tax benefit in the year that I purchased and then turn it into sort of passive income the following year. But talk to us about this little STR loophole that I keep hearing about. What is it and why should we care?
Yeah, it's definitely related to what we're saying, like most people who invest in long-term rentals, it's like, hey, I'm getting all these tax benefits from write-offs and depreciation, but if I have high income, I can't use it against W-2. And the biggest hurdle is because it's one of the rules is you have to spend more time in real estate than your job. So unless you're heavily involved in real estate, most people will never overcome that hurdle. And that's where the short-term rental loophole comes in. So in the tax world, if you invest in a short-term rental and you strategically create these losses that we're talking about, right? Paying your kids, writing off your new car that Mauricio is buying. So if you're doing that and it's related to a short-term rental, you can potentially use that loss against your W-2 income or your business income, even if you are not a real estate professional. So when it comes to short-term rentals, you only have to meet one of those requirements, which is material participation. So as long as you have material participation in the short-term rentals, now all those losses can offset your W-2 income. And so this works really well for our clients who are high income earners and doing real estate almost like as a side hustle, right? So maybe I have, 1, 2, or 3 short-term rentals. As long as I have enough hours on those, then I can use those losses against my W-2 income and get some pretty hefty tax savings.
And this isn't unique to short-term rentals, right? I mean, I've heard this strategy. I'm actually thinking about it, to be honest with you, with something like a laundromat, right? I could buy a laundromat and I could materially participate in that in order to get those benefits. What I've been trying to do is, and I think I figured it out, I just haven't done it, but there's a way, I believe, to do that in the year. So you acquire the property. Let's say this is perfect. We're in November, right? So if I acquired a short-term rental, or I acquired a laundromat or something like, or a business like that, and I materially participated this year, which I think might be, I think it's, what is it, like 100 hours and more, spending more time than any other employee. Is that the one of the, I know there's several definitions, but is that the easiest one to get?
Yeah, there's actually 3 ways to qualify. So it's either you have 500 hours or you have 100 hours and nobody else has more time than you. Or the third one, which is you spend more time than everybody else combined. And so, yeah, it's really powerful when we talk about year-end planning, because if you bought a laundromat, for example, and you're the only person who's there, you're setting it up, you're just doing everything there is to do, then it's very easy, right? You can meet that third one, which is you have more time than everyone else combined. And then you'll be able to do, depreciation and all that stuff to offset income. So yeah, we see laundromat a lot. Sometimes like convenience store, gas station type of things, we see that. And then yeah, short-term rentals, boutique hotels.
Is it possible, this is a timing issue, but is it possible for me to acquire the laundromat or the short-term rental, let's just say in December, right? So, and I bust my butt and just, it's Christmas, although that's a problem, right? It's Christmas and Thanksgiving, but let's just say I just bust my butt and I work my 100 hours in December. I work more than any other employee. I get all my deductions in for this year. And then next year I decide to just outsource the whole thing and bring in a management company, and now it becomes completely passive. That counts as passive income to me at that point, right? For next year?
Yeah. Yeah. And actually for some of our clients, it actually is the best of both worlds, right? So meaning this year I'm meeting material participation. So it's a regular loss. I get to use it to offset my, law firm income. And next year, fast forward now, theoretically, my short-term rental is very profitable because I have all the systems in place. And I don't have as many write-offs because, I already took all that depreciation in the first year. And so now if it's passive and I happen to have a lot of other passive losses, let's say because I invest in apartment syndications, right? And now I can use my passive losses to offset the passive income on that short-term rental in the subsequent year. So yeah, there's definitely some really great strategies when you're doing multi-year planning, right? Which is kind of what you're describing. What is it like this year? What is it like next year? There's no requirement in the IRS that says this property must remain as a short-term rental. And in fact, if the average guest stay is greater than 7, it automatically is no longer a short-term rental. It's just defined as a long-term rental for tax purposes. But having said that, I will throw out a caveat because I have had investors say this to me, like, what if I just rent it as a short-term rental for 2 days this year, and then immediately it's going to turn into a long-term rental, and I'm just not going to manage anything starting January 1st? That's maybe a little bit risky, right? You don't want to just have the facts shift immediately and so drastically right away. I would still try to operate it, be a little bit more hands-on, at least for the next couple months, and then transition it into something more passive, right? Because again, there's not a requirement that you always keep it active, but we also don't want to have just like a very fishy thing where it's like 2 tenants and then that's it forever.
No, absolutely. Guys, this is all, I mean, if you're not having these types of conversations with your CPA, you should be, or you should be working with somebody like Amanda. I mean, this is the reason why you're meeting with your CPA throughout the year and not just showing up at the end. All these things, you can't work on all this stuff if you're talking to your CPA in March, if the CPA is even talking to you in March, because they're probably not taking any new calls. So this is why, I like to meet with CPAs throughout the year. How often do you recommend, Amanda, for your clients? They talk to you every quarter, every month, twice a year? Like what is your general recommendation for your clients?
Yeah, I mean, that's a great question. I get that one a lot. How frequently should you meet with your CPA? I think it just depends on the person. And also depends, for that given person, it could be different from year to year too. So, for some of our larger clients, we meet quarterly. Some of them we meet monthly just because there's so much volume of things. You and I, we have some joint larger clients. It's like things are changing every day, right? So we got to be on top of it. But I think for the majority of our clients, when we work with them, they kind of get access to us on an as needed basis. And so the reason for that is because during the year, they might be having different transactions at different paces. Maybe the first 3 months, there's nothing going on. We don't have to meet if there's nothing going on at all. But then they might have a deal under contract. They might be having an issue with their partnership. So we might be talking a couple times a week, right? Trying to resolve those issues. So from an investor's perspective, what I always tell our clients at least is, your CPA should always be someone on your team. Like if you're contemplating any kind of significant transactions, buy, sell, refinance, partnering, moving. And it's just a quick email like, hey, Amanda, I'm thinking of doing this. And from that, I can say, okay, let's talk about what the implications are, what the opportunities are. It doesn't always have to be a very in-depth conversation. Sometimes it's a pretty easy, like, okay, let's, we're already good. But really the main job of the investor is to just let the tax advisor know, here's what I think I want to do, or here's what I'm contemplating.
Before, because I so many times, and on my end, I see it and then I pass it along to the CPA, but it's like, hey, I'm about to get a huge payout from this sale or whatever. It's like, how do I save on taxes? It's like, no. This is something you should have discussed 7 years ago when you got into the deal. We could have structured it in such a way to minimize your taxes, not now.
Yeah, it's very important. And I think that, we're doing a good job with like podcasts like this, right? Just like sharing stuff that right now I have a couple clients who we are working on some exit strategy planning for 2027. And I think the more significant the dollar amount is that we're talking about, the sooner you need to start planning. Because if we're saying, hey, we have $1 million of gain coming, okay, maybe we can plan for that this year for next year. But if we're talking about a $20 million gain, I mean, that's a lot of real estate. That's a lot of charitable planning. There's a lot of different moving pieces that we need several years to be like, okay, how are we going to create the right fact patterns so that by the time this gain hits, we're not surprised with, oh yeah, 60 days. What are we going to do?
100%. Hey, Paula, thanks for the comment here. Paula was saying, everyone remember to save the chat. This is pure gold. Yeah, go ahead and save the chat. because there's a lot of good stuff going on in there as well. Let's reward Paula with are you up for an oil and gas question?
Sure.
Oil and gas royalties will still enjoy 15% depletion tax credit, right? If we invest in a syndication at the time, at this late time of the year, it may take 45 days to close. So we may not have time to do a cost seg or bonus depreciation. Is it best to try to invest next year and get a different investment that will benefit taxes now? Does that make sense?
Well, so for oil and gas, and really, oil and gas, it really depends on how the partnership is set up. So we've seen it different ways. But purely from a tax perspective, when a client comes to me and says, "Hey, I'm investing in oil and gas for the tax benefits," those are usually because they're set up as general partnerships in the first year, and we get that high, depletion basically of that investment. And then depending on how they plan to use that money before year end, we've seen it, as high as 100% deduction. So you invest $100,000, it's $100,000 loss on the K1, all the way down to like 30%. So that really just depends on how much of the money that they're raising is actually being put into the drilling and things like that. So yeah, I think, because most of our clients are heavily involved in real estate, oil and gas is always like a secondary or third in line. It's always like, what kind of rentals or syndication can I put my money in? And if it's like nothing works out, then, maybe I'll do some oil and gas. Yeah, they're kind of reluctant, but I don't know. I think, and it's only because in terms of my client profile, it's so heavy real estate, that, people just prefer to have real estate.
No, 100%. I should have probably asked this question earlier because it was relating to our material participation, but I don't want to let go. I don't know if this is the Jimena Kunich, but if it is, it's cool. If not, I don't know. When having real estate in other states, all the hours discussing rehabs or other repairs with your real estate management team and or revising their monthly reports, does that count against the material or count towards the material participation?
So discussing rehabs with your management. So
out of state.
That's a great question.
The real estate's out of state, right? So it's not like I'm literally physically, it's going to be all on the phone and discussing all that stuff.
Yeah. So that's a common misconception. I think people feel like material participation has to be something in state, like you're there getting your hands dirty. That's not necessarily the case. So yeah, if I have, out of state rental properties, but I'm dealing with the tenants, I'm firing the property management company because I have to replace them with a new property management company. I'm making decisions, right, as the owner. Those are all material participation. So it doesn't have to be like get your hand dirty kind of hours. Now, having said that, there are a couple of things that are kind of quirky. So one I get a lot, of course, is bookkeeping time. Bookkeeping time, is that material participation or just regular real estate professional? And tax courts have ruled time and time again that there's a difference. If you don't have a property management company, you self-manage, then bookkeeping time, even though it's just financial stuff, it is part of material participation. But if you have a property management company, then those hours are no longer material participation. So that is a distinction. What we tell a lot of our, because we do have, even though we have clients all over the US, we still have a good percentage of people in California who love to invest out of state. And one thing to consider is like, you might have out of state properties managed by property management companies where you don't do anything with at all. But if you had like one or two local properties that you maybe self-manage or you're very hands-on and you earn enough hours, let's say we're using 500 as an example, then that's all you need because you can combine all your hours, right? So let's say my California properties got 500 hours and I got a dozen properties in Florida where I spent no time because they're property managed. That's fine. I still meet those requirements because I can combine everything together to meet those hours.
Good stuff. Now, I know this is a good one because it involves one of my favorites, I guess, which is the home office deduction. Paula mentions that since COVID, obviously, a lot of folks have had to either forced or spending a lot more time in home offices. Can you talk about the deductions that are acceptable for having a home office, such as utilities, landscaping, water, etc.? She's creating a spreadsheet. Maybe that's best practices to keep track of all these, but what's acceptable? It's not. Can I deduct the water of my yard that I spend on the yard, or what can and cannot expense on when you have your home office?
Yeah, that's a great question. So home office is a huge one. for real estate investors, and especially for those of you who live in expensive areas, right? Like California, New York, because basically what we're doing is we're taking a percentage of our household expenses that are typically personal, non-deductible, and we're turning them into legitimate business write-offs. And you're right, pre or post COVID, I mean, I don't really know many investors who rent an office space to manage their properties or to deal with properties, right? The vast majority of us deal with properties from our home. In terms of what you can write off, it's really just general household items. So like, yeah, cleaning, if you have like cleaners come to clean your home, right? That's part of your household expenses, interest, property taxes, insurance, security, all those good things. With respect to landscaping, that's a tricky one because for the most part, yard work, landscaping, usually they don't consider that part of home office. I know people argue like, hey, that's, making, if I have clients coming, I can't just really have a, dead lawn or anything. But historically speaking, IRS has said those types of things are not part of your home office, but certainly things that are inside the home. And the tip I would give too is because the home office is based on number of rooms or square footage, right? In comparison of the office space in comparison to your whole home, the larger the home office space is, the better it is. So for those of you with basements, those are ones we see like very significant write-off because that's almost like, a third of the square footage of your entire home. Right. Lofts, basements, those are all really great. Things that we don't have in California.
Yeah, no, we definitely don't have any of that stuff. Amanda, I know it's, I told you I'd get you out of here in about 45 minutes. Can I ask you one, like, there's so many more questions here. We're going to probably have to have you back and finish up all these questions, but anything we missed? I mean, we've kind of like, I had my questions, we had questions. Are there any questions we didn't ask that we should have? Are there great strategies that we don't really know about, obviously, and that you were recommending?
Oh my gosh. I mean, there's so many, like you said, we'll probably talk for another 8 hours about it.
But nothing that really stands out on the real estate side?
Yeah, I mean, this year, obviously, we currently have 80% bonus depreciation. There was a bill that's kind of still in the works of potentially bringing it back to 100% bonus depreciation, retroactive to January 2023. So, no, it's anyone's guess whether that will actually come to fruition. But, absent any changes, right, next year, we're scheduled to go down to 60%. So for those of you who are still shopping for real estate, looking for ways to reduce taxes, I would try to be very intentional and aggressive about what you purchase and what you put into place in the next, 60 days or so. With respect to your employee, I guess some of the biggest things is our ability to defer income as real estate investors. I think this might be more, on the syndication side, or even for those of you who just, own rental properties. If we have a property that's going to sell soon, if we can delay the closing of the sale even by 1 day from December 31st of this year to January 1st of next year, we delay the taxes for a whole entire year, right? So it's not due next April, but the following April. Yeah. And for any of you selling businesses, that's a huge one, because then you have a whole year to strategize on how am I going to redeploy the money to offset the gain, versus if we close on something December 31st, you have literally like no time to offset some of those things. And, from a sponsor's perspective, like we said earlier, this is a really great time to be talking to investors. Like, hey, did you have gains that you need to offset? Did you sell your own properties? Maybe you have clients who exited one investment with a huge gain. Well, now you have this other investment you want to try to get them into so that they could, not pay a bunch of taxes by next April too.
Awesome. I'm going to put, make sure I put your contact, your website in the chat, but what's a good way for people to get a hold of you if they're interested in reaching out to you?
So our company is called Keystone CPA. So it's KeystoneCPA.com is the best place. We have a lot of,
that's in the chat.
Yeah, we have a lot of great free resources for investors. So if like real estate professional, short-term Loophole, if this is the first time you're hearing about it, definitely download our free resources. We have a ton of information on that. For those of you who are sponsors and syndicators, we actually just put out a new piece. It's not even on our website yet. It is a book on ebook on tax benefits for passive investors, where we go through, because, I'm sure, Mauricio, you hear this a lot too, where CPAs will tell people, don't invest in syndications. You don't get any tax benefits. You're just passive. So we kind of break through that noise and tell investors exactly what they can and cannot use with passive losses. So that was not on our website, but if any of you guys are interested in that or sharing that with your investors, shoot me an email, ahan, AHAN at KeystoneCPA.com, and I'll share that with you guys. If you are looking for daily tax tips, the best place to find me is on social media. I am Amanda Han CPA on Instagram and also on Facebook.
And you have a course, right? We were talking about that the other day. Don't you have a tax course?
Yeah, I do. So we have a tax course. So on our consulting side, we work with investors on how to do strategies, but we created a course a couple years ago, more for like newer investors who are starting out. And it's basically just like a more affordable way for them to get access to all the strategies that we use with our one-on-one tax planning clients. So we go over like, legal entity considerations from the tax perspective. How do you track your hours? Like what kind of templates and systems you can use for your bookkeeping and real estate professional status. And so we've gotten some really great feedback. I was initially like, who's going to take a tax course, but we've gotten some really amazing feedback so far in the last 2 years or so.
That's awesome. Amanda, thanks so much. I know you're busy, and really, I think on behalf of the entire community, really, really appreciate you taking the time, and always good to see you, my friend.
Yeah, thanks for having me. I hope to come back soon.
Oh, absolutely. We'll finish up all these questions that are piling in, so we'll have you back. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.